How does a seed funding term sheet work? Imagine you're about to start a journey with your new business and you need some help to get going. You meet investors who are interested in supporting your idea. Before you shake hands and start working together, there's a document that lays out what both sides expect. That's what a seed funding term sheet is. It's a simple, non-binding paper that spells out the main points of the investment deal. Think of it as a blueprint that guides the final agreement. The term sheet usually states how much money the investors will put into your startup. It also describes what kind of securities they will get in exchange, like convertible notes, simple agreements for future equity, or actual shares of stock. It then sets the valuation of your company, which decides how much ownership the investors will receive and how much your shares might get diluted. Next, it covers governance details. This includes how many board members the investors can appoint and what voting rights they have. It also explains what happens if your company is sold or liquidated. This is called liquidation preference, and it determines how the proceeds are divided. The document might also include protections for investors, such as anti-dilution clauses, dividends, and rights to convert their securities into stock later on. The current ownership structure, called the capitalization table, is part of the term sheet. It shows who owns what before and after the investment. It also covers vesting schedules for founders and employees, which means how and when they earn their stock options. Confidentiality and exclusivity clauses might also be included, preventing either side from shopping around during negotiations. For founders, understanding this document is key because it affects who controls the company, how much ownership they keep, and their ability to raise more money later. Since investors often draft the term sheet to protect their interests, founders should review each term carefully and negotiate where possible. The benefit of a term sheet is that it puts everything in writing upfront, reducing misunderstandings. It gives both sides a clear picture of the deal and helps them decide if they want to move forward. If the terms don't work for either party, they can walk away without losing much time or effort. For founders, a well-understood term sheet shows how much equity they will keep and what rights investors will have. It highlights important financial and control terms that influence the future of the company. For example, a large employee stock option pool or aggressive liquidation preferences can cut into the founders' ownership and potential returns. In short, a seed funding term sheet is a detailed outline of the investment deal. It balances the needs of both founders and investors, making it easier to build a strong partnership. Knowing what each part of the term sheet means helps founders negotiate better terms and set a solid foundation for future funding rounds.